Hey there, Investing Iguanas. Iggy here, and today we're diving into a fascinating case study that's sure to blow your mind. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 410,000 reads. Imagine a country with a staggering 170% debt-to-GDP ratio. Sounds like a recipe for financial disaster, right? But what if I told you this same country has a $1 trillion fortune and a rock-solid economy? Buckle up, because in this video, we're uncovering Singapore's shocking debt secret and how this tiny nation turned a mountain of debt into a massive wealth machine. Trust me, you won't want to miss this one. Singapore, a small island nation in Southeast Asia, has earned a reputation as a model of fiscal responsibility. This reputation is built on a foundation of consistently running budget surpluses, which means that the government's revenue exceeds its expenditures. This is a clear indication of the country's strong financial management and economic stability. In addition to this, Singapore's constitution has a unique provision that essentially prohibits the government from borrowing money for the purpose of financing its day-to-day operations. This is a significant departure from the practices of many other countries, where borrowing to cover operational costs is quite common. This constitutional provision ensures that the government lives within its means and reinforces Singapore's commitment to fiscal responsibility. The strength of Singapore's fiscal position is recognized by the world's 3 major credit rating agencies, all of which have awarded the country their highest AAA ratings. These ratings are a testament to the country's strong economic fundamentals, prudent fiscal management, and robust financial sector. Furthermore, the International Monetary Fund, IMF, a global organization that promotes financial stability and economic growth, has also acknowledged the low risks associated with Singapore's debt. This is another endorsement of the country's sound fiscal policies and its ability to manage its debt effectively. However, despite all these positive indicators, Singapore's debt-to-GDP ratio appears to be quite high. This might seem contradictory at first, but it's important to understand what this ratio represents. The debt-to-GDP ratio is a measure of a country's public debt in relation to its gross domestic product, GDP. A high ratio could indicate that a country has a large amount of debt relative to the size of its economy. But in Singapore's case, the high debt ratio does not necessarily signify a problem. This is because a significant portion of the government's liabilities are in the form of Central Provident Fund, CPF, obligations. The CPF is a comprehensive social security savings plan that has helped Singaporeans save for their retirement, healthcare, and housing needs. The government invests these funds, and the returns are used to pay CPF members. Therefore, while these obligations contribute to a high debt-to-GDP ratio, they are backed by assets and do not pose a risk to the country's fiscal health. Let's delve into the financial strategies of Singapore, specifically focusing on the role of its central bank, the Monetary Authority of Singapore, MAS. The MAS has a crucial responsibility to maintain the stability of the Singaporean dollar. This is important because a strong currency can have significant impacts on a country's economy, affecting everything from trade balances to inflation rates. To prevent the Singaporean dollar from becoming too strong, the MAS has been actively involved in the foreign exchange market. This involves selling Singaporean dollars and buying foreign currencies. This strategy is not uncommon among central banks as it helps to manage the value of the domestic currency. The outcome of this strategy by the MAS has led to the accumulation of a substantial amount of foreign exchange reserves. These reserves are essentially stocks of foreign currency, and they are much larger than what the country actually needs for its day-to-day operations. Having large foreign exchange reserves can be beneficial as it provides a buffer against potential economic shocks and can help to maintain confidence in the country's economy. However, this situation also presents a unique challenge. The government ends up with more funds than it needs, and these funds need to be managed effectively. One solution that the Singaporean government has implemented is to issue debt to the central bank. This might sound counterintuitive, but it's a strategic move. Issuing debt allows the government to borrow money from the central bank, which effectively means that the government is borrowing its own funds. This strategy has resulted in a significant amount of debt, equivalent to about 40% of the country's gross domestic product, GDP. GDP is a measure of the total value of all goods and services produced by a country in a given period, and it's often used as an indicator of a country's economic health. While a debt-to-GDP ratio of 40% might seem high, it's important to remember that this debt is essentially owed to the country's own central bank. This means that the government has a high degree of control over this debt, and it doesn't pose the same risks as external debt, which is owed to foreign lenders. Let's take a closer look at Singapore's social security system, known as the Central Provident Fund, CPF. The CPF is a key pillar of Singapore's comprehensive social safety net, and it plays a vital role in ensuring the financial security of Singapore's residents. In Singapore, both employees and their employers are required to contribute a significant portion of their salaries to the CPF. These contributions are mandatory and are set at a rate determined by the government. The CPF is a form of forced savings, and it ensures that residents have funds set aside for their future needs. The funds accumulated in the CPF can be used for a variety of purposes. These include healthcare costs, housing purchases, and retirement savings. This multi-purpose nature of the CPF makes it a versatile tool for financial planning. It allows residents to manage their finances in a way that suits their individual needs and circumstances. However, there's an interesting twist to how the CPF operates. The money that residents and their employers contribute to the CPF doesn't just sit in an account. Instead, these funds are handed back to the government. In return, the government issues special non-tradable government debt certificates to the CPF. These debt certificates are a unique feature of Singapore's social security system. They represent a promise by the government to repay the funds to the CPF members when they need to use them. Because these certificates are non-tradable, they can't be bought or sold on the open market. This ensures that the funds remain secure and are available for the members when they need them. Now, you might be wondering about the scale of these debt certificates. It turns out that they make up a substantial portion of Singapore's gross domestic product, GDP. In fact, these certificates account for over 90% of Singapore's GDP. This is a staggering figure, and it underscores the scale of the CPF and its importance to Singapore's economy. In essence, the CPF is a cornerstone of Singapore's social security system. It provides a mandatory savings scheme for residents, helping them to secure their financial future. The unique mechanism of exchanging CPF contributions for non-tradable government debt certificates ensures the safety of the funds and contributes significantly to Singapore's GDP. Despite the complexity, this system is a testament to Singapore's innovative approach to social security and fiscal management. Singapore's financial strategies extend beyond its unique approach to managing reserves and the CPF system. The country also places a high value on maintaining a robust bond market. In many Western countries, bond markets are often viewed primarily as a mechanism for governments to borrow money. However, Singapore sees its bond market in a broader context, considering it a public good that benefits the entire economy. The Asian financial crisis in 1997 served as a catalyst for Singapore to strengthen its bond market. The crisis highlighted the risks of relying too heavily on banks for corporate financing. In response, Singapore took steps to ensure that companies could raise money through bonds, providing an alternative to bank financing. This move was aimed at diversifying the sources of corporate financing and reducing the economy's vulnerability to banking sector shocks. The issuance of bonds provides companies with the capital they need to invest, grow, and create jobs. At the same time, it offers investors a way to earn returns on their money. This dual benefit makes the bond market a vital component of Singapore's financial ecosystem. The bonds and bills sold in the market have a significant impact on Singapore's debt-to-GDP ratio. This ratio is a measure of a country's debt compared to its overall economic output. In Singapore's case, the bonds and bills sold in the market add another 40% to this ratio. While this might seem like a large figure, it's important to remember that these bonds represent money that is being invested back into the economy. They are not a form of debt that the government needs to repay out of its own pocket. Indeed, it's important to note that debt-fueled investments by governments can sometimes lead to unfavorable outcomes. There have been instances in the past where such strategies have not worked out as planned. For example, the Woking Council in the UK and Dubai World in 2009 serve as cautionary tales. These cases, however, seem to be more about mismanagement and incompetence rather than sheer bad luck. The key takeaway here is that while debt can be risky, it can also be a powerful tool when used wisely. This is evident in the case of Singapore. The city-state has been rewarded for its willingness to take on market risk. Its strategic investments often yield dividends that are substantial enough to turn budget deficits into surpluses. This is a remarkable achievement and a testament to the effectiveness of Singapore's financial strategies. Fiscal rules, such as limits on borrowing and spending, can be useful for keeping debt in check. They provide a framework for fiscal discipline and help ensure that governments live within their means. However, Singapore's experience shows that higher debt isn't necessarily a bad thing. What matters is how the debt is used. In Singapore's case, the debt is used for smart investments that generate returns. These returns not only cover the cost of the debt but also contribute to the country's economic growth and financial stability. This approach has allowed Singapore to build a strong and resilient economy despite its high debt-to-GDP ratio. In conclusion, while debt can be risky, it can also be a strategic tool for economic development. The key is to manage the debt effectively and use it for productive purposes. Singapore's success in this regard offers valuable lessons for other countries. It shows that with prudent management and strategic investments, it is possible to turn debt into an asset rather than a liability. So there you have it, Investing Iguanas, the incredible story of how Singapore turned a jaw-dropping debt load into a trillion-dollar treasure chest. It's a masterclass in strategic financial management and a reminder that sometimes unconventional approaches can yield amazing results. But hey, don't just take my word for it. I want to hear from you. What do you think about Singapore's debt strategy? Is it genius or just plain crazy? Let me know in the comments below. And if you found this video eye-opening, be sure to smash that like button and subscribe to the Investing Iguana channel for more mind-blowing financial insights. Remember, knowledge is power, and we're here to empower you on your journey to financial freedom. Until next time, this is Iggy, signing off. Stay savvy, Investing Iguanas.